We're calling this uncertain certainty.
Can't walk out. Elvis Presley.
The volatility of bid-ask spreads. We are going to look and see if the markets are busy and volatility is high. Are the markets really better or worse? Most people would say worse. Maybe they're better. No one is absolutely sure of their models. That is why market makers maintain a bid-ask spread to give themselves room to be wrong. In active underlyings, the size of the bid-ask spread can be seen as the market makers' degree of doubt in their own models. On the other hand, while the best guess for future prices are current prices, up from risk-free rate, thanks to efficient market theory, volatility expresses roughly how uncertain the markets are of that guess. Let's examine the two measures of uncertainty and how they relate to each other. Let's go to the next slide. So we use 10 years of data in the SPY options. We examine the bid-ask spread every 45 days for every day for 45 DTE strangles with strikes at the money, that's at half the expected move, and at the expected move, and then at 1.5 times the expected move.
At the expected move, the expected move, the expected.
So at the money, half the expected move, at the expected move, and 1.5 times the expected move.
Okay.
We found the average size of the bid-ask spreads overall and conditioned on the level of the VIX. We consider the bid-ask spreads both as raw dollar amounts and as percentages of the initial credit. Let's go to the next slide. Okay, so now we're going to have a little fun with this stuff, and there's a lot of stuff here. So we're gonna take you through this. So
should we look at the overall as the one to look at, or what do we look?
No, because what we're doing is we're looking at lots of different. Let me just take through this.
Okay, go ahead. Go ahead.
The way this, if you go to 1.5, the last line, the 1.5 times the expected move for strangles. Mm-hmm. Okay, the point we're really trying to make here is that the markets are, the spread is not really any worse than it is if you were, like, let's say the VIX was at 20 or the VIX was at 25. The point that we're making here is that as volatility gets higher, the markets don't necessarily get worse because you're collecting so much more money. Mm-hmm. So when you look at a straddle, right, just as I'll look at the top line, and let's just say that in the S&Ps, the normal volatility, let's just say volatility is 20, the market's 24 cents wide, all right?
Okay.
And let's say the VIX is over 30, wherever it is now or whatever.
Sure.
And the market's 37 cents wide. 37 cents is probably tighter than 24 cents because the price of the options.
Not literally, but when you factor in volatility.
Yes. Mm-hmm. Here, the easiest way to say this is at 15, it's 18 cents. At 30, it's twice that at 37 cents. So is it really are the markets really wide?
In that example, they're basically equal.
Well, yeah, but you don't, this just says over 30.
I know.
It says under 15.
I'm just giving you, in that example that you used, it's basically the same.
Yes. And as you go further down the line here and look at like half the expected move, and 1.5 times the expected move, the numbers are actually support the fact that it's actually tighter. Mm-hmm. Let's go to the next slide. So we see that when volatility is high, even in the best underlyings, the bid-ask spread tends to come apart a little bit. In fact, the correlation between the VIX and the size of the bid-ask spread was about 0.44. So as retail traders, this can leave us either waiting for a fill around mid-price or accepting a small loss if we want to adjust. But by gauging how certain market makers are in their own prices, the bid-ask spread should be viewed in relation to the prices of the options themselves. Let's go to the next slide. So when we view this in relation to the option prices themselves, okay, because remember the price went up. Take a look at this slide, Tony, because this is really interesting. In fact, in relation to the option prices themselves, the percentage is virtually the same. In some cases, on outlier moves, it's even lower.
Yeah. Amazing, isn't it?
So, do you remember when?
Now again, we're looking at a tight liquid market here, right? We're not. This is not.
This is right. We are. But this is where we have most of the data.
Mm-hmm.
But when we go to the expected move strangles, overall, it's 3.2% of the width. The VIX is over 30. It's only 2.7. When the VIX is over 25, it's only 3. When the VIX is over 20, it's 2.9. The point being here is that we talk about how important high frequency market making is. We talk about how important payment for order flow is. We talk about how important the system is today between market making firms, exchanges, and retail customers. And the give up to theoretical, the bid-ask spread, is even tighter when markets get even crazier. That is not the way it used to be.
No.
That's how efficient everything has become. Mm-hmm. That's what we want to see happen in the world of sports gambling. That's what we want to see happen in every single marketplace that exists today, is this kind of efficiency. The louder and the noisier the markets get, the more efficient everything gets.
It's amazing, isn't it?
Yeah. Just so you know, like, just to give you an example, real estate is like 150 times wider than this.
And just the opposite. When
Sports,
there's uncertainty,
yeah, 100%.
Yeah.
Sports betting, 100x of this.
Yeah.
100x. Real estate, like 150x.
Legitimate, not just.
Yeah, no, this is not just making up numbers. It's crazy. So in dollar terms, the bid-ask spread increased both as volatility increased and as we looked closer at the money. However, higher volatility also means higher option prices, and the bid-ask spreads do not increase quite as quickly. This leads to roughly consistently liquid option markets in percentage terms, with further out-of-the-money options actually being slightly more liquid in high volatility. While high volatility might speak to the greater uncertainty of the future underlying prices, it also means that traders and market makers have less to worry about when it comes to sudden spikes in volatility. Don't let apparently wider seeming markets dissuade you from taking advantage of high implied volatility environments. They provide us with an opportunity to push our strikes out while collecting good credits from liquid markets. Making the argument that when people say you got to stay away when things aren't efficient, it's not true.